Hey everyone, it's Imran from Options Insight, your macro options spotlight for today. Remember, for the algo, like, comment, subscribe, do what you got to do so this information gets out all over the place. Okay, stocks flat yesterday. January OPEX on the S&P seems to be quite a force of gravity. That 4,000 level really struggling to shake it off right now. And that's also evidenced by the idea that implied vol got absolutely destroyed into the end of last week on those super short dated options. And generally, when that happens, that tends to signal that dealers are long and they're choking on that optionality, and those theta bills are exploding, and it kind of becomes a bit self-fulfilling that the market just can't shake it off until expiry. So now we could always get a big news event that comes out of the blue that the market's not expecting, and we do shake it off. But at the margin, it does seem fairly unlikely now, given that we're not managing to go anywhere. So once that expiry rolls off at the start of Friday morning, then the market's maybe freed up to have its natural move, whatever that wants to be. Personally, I'm of the camp that it probably wants to move higher. A good friend of mine, Brent from Spot Gamma, we had a discussion yesterday on his YouTube channel. He seems to think it's probably more likely to go down first. But, you know, we both agree that the chances are realized volatility doesn't do a lot until after Friday. Now, in terms of other stuff, China having a bit of a pullback, 2% lower on the day. Just a little pause there after the amazing rally that it's had. And then Japan's also bouncing. It bounced yesterday 1%. It's up again a couple of percent. That's because the Bank of Japan didn't really do a lot with their yield curve control policy. Market was speculating that they would do something. They didn't. They held firm, and we had the yen respond, and we saw yields fall back below that 50 bip cap as they come in, and they kind of promised to buy a load of bonds, and they have been buying a hell of a lot of bonds recently. And then precious metals having a pause. Gold miners getting hit 3.5%. That's a pretty healthy 1.5 sigma move on the day. And energy actually continuing to build on its momentum. Crude oil looking pretty strong right now. Natural gas also had a bit of a bounce, but it's been beaten up pretty badly recently. Okay, volatility wise, we did see a reflexive bounce in vol. US indices up over a vol point. But I wouldn't read too much into that they got a bit oversold into the holiday with the 3-day weekend. So it's quite typical for that sort of thing to happen. And you can see the other indices not really doing a whole lot in terms of vol, slightly higher, but nothing really meaningful. Commodity vols also rallying back a bit, except for nat gas, which got smoked, 6.5 vols on the day. But in general, commodity vols picking back up as well, because we did see just a broad-based cross-asset vol sell-off at the end of last week. In terms of skew, we are seeing skew recovering a bit in the S&P. We'll talk more about that in a bit. But generally, a bit of a mixed bag on skew all over the place. But it continues to be quite flat across all the major indices here in the lower percentiles. And we've talked about this again and again as to why that is in terms of people needing protection to the upside because they're relatively underweight. Okay, moving on, Bank of Japan. Obviously, we said they didn't do a lot overnight, and we got the knee-jerk moves. But you can see the chart here on the right just shows just how much they've been buying, right? So this is kind of their holdings of JGBs and how much they've had to buy. And we're talking in the hundreds of billions, right, that these guys are having to buy. And this is why a lot of market speculators think that this is an untenable situation. There's got to be a limit to how much they're going to buy here to support this policy that, you know, you can clearly see they want to remove, but they're quite scared of removing too violently because of the repercussions it will have for asset markets, basically. So they've kind of backed themselves into a bit of a corner here, it looks like. For now, Kuroda's managed to get the yields back below the cap, but I wouldn't be surprised if this continues to see pressure as people get the hell out of Dodge, because they know at some point these guys want to exit this policy. They might leave it for the next in charge, which may happen, in a few months' time, but that does seem to be the way that they're heading right now. And then outside of that, Bank of America fund manager survey, always a good one to kind of have a look at. Cash levels have come down from October levels. So there was a bit of a peak above 6%, down to around 5 and a bit percent. But if you look at over the long term, it's still got quite a lot of room to go. So whilst cash has been deployed onto risk assets, we do think there's still a lot more powder to be put to work. If we are starting to see net liquidity turn higher, we are seeing a bit more of a Goldilocks regime coming back, and the recession that most investors were fearful of has to get pushed back a couple of quarters, then there may be more upside pain to come. as investors have to address these underweights. And we need to see cash levels come down below that key sort of 5% level, between 4 and 5%, before we think money has fully been put back to work and we can worry about the downside again, right? So that's the thing I'm keeping an eye on. I do believe that the pain trade remains higher, and I wouldn't be surprised if over the next few weeks, provided earnings don't come in as a shocker for this quarter just gone, which I don't think they will, then we may get some more upside, basically. And then we're going to take a look at NASDAQ. So on the whole thing about earnings season, we've got the big tech starting to report next week. We've got Tesla and Microsoft next week. And then we've got the big boys, Apple, Amazon, etc., the week after, Google. So, since October last year, we can see quite a big outperformance of the Dow Jones relative to the NASDAQ. So the two ETFs here are the DAI and the Qs. So you've seen about 15 to 20% outperformance of the DAI. So that, the old economy names, the kind of safe names like McDonald's and that are rallying to highs and stuff. So this thing's really outperformed. So now the question is, if we do get another rally from here, the next leg of the rally, is it led by the Dow Jones names, or is it led by a catch-up trade happening in things like tech and some of these more cyclical names, right? Under the hood, we're already starting to see the cyclical names outperforming, right? And the defensive names like your staples, your utilities, your healthcare, they kind of aren't going anywhere because they didn't sell off as much last year. They were like the safe place to park your capital. And so now if people are going to do a beta chase for some performance early in the year, I don't think they're going to be doing it in defensive names, right? So the question is, does tech have a comeback? Okay. Now the big FANG names were down since sort of September, October, anywhere between 20 and 50%. We've got Tesla, obviously worst hit, but Microsoft and Apple, they've been the better performers, but they're still down nearly 20%. Meta's down 25%, but at some point it was down 50%. So Meta has started to recover. So the market is starting to forgive Meta a little bit after some of the craziness that they did going into the virtual space and the whole metaverse pivot, which was quite ill-timed by the looks of it. They are cost-cutting pretty aggressively, and the market seems to be rewarding them to some extent for that, okay? So the question is, as we go through earnings season and we see more cost-cutting, are these other tech names going to have a bit of a recovery? Because right now, they're feeling quite beaten up. Now, on a longer-term perspective, maybe valuations are still high. I don't know. That's not really what I do, analyzing valuations. But I just think at the margin, no one owns this stuff. An example of that is that, again, the fund manager survey from Bank of America showed that asset allocators are the most underweight US stocks since 2005, okay, which is a pretty big statistic there, okay? So that suggests to me that maybe the US market can have a little bit of a squeeze because people don't own it, and they certainly don't own tech, right? Because everyone's got quite bared up on tech. So I think there's room for tech to have a bit of a comeback. I don't think it's necessarily going to be that long-lived, but I wouldn't be surprised if that's where the next pain point is. And some of these big cap FANG names that report in the next 2 weeks could do quite well and take this market higher. How would I play that? That's the question. Okay, so if we look at the trade idea, all right, that's it for today. Thanks a lot for listening. I'll catch you all tomorrow. Cheers.